Government bonds are like loans. You lend money to the government. The government promises to pay you back. You get your original money back plus interest. It's that simple. Think of it as lending a friend a tenner. They promise to give you 11 quid back later. The extra quid is your interest. It's your reward for lending the money. Bonds are considered a very safe investment. Governments are generally good for their word. They're not likely to disappear overnight. This makes bonds less risky than stocks. Of course, like any investment, there is always some risk, but government bonds are about as safe as it gets. That's why so many people invest in them. Governments need money to run things. From maintaining public services to funding new projects, the financial needs of a government are vast and varied. They collect taxes, of course. Taxes are the primary source of revenue for most governments, helping to pay for everything from public safety to education. But sometimes they need extra cash. They could raise taxes, but nobody likes that. Raising taxes can be politically unpopular and economically challenging, especially during tough times. That's where bonds come in. Bonds are essentially IOUs issued by the government, promising to pay back the borrowed amount with interest. Governments issue bonds to borrow money from people like you and me. This allows them to raise funds without immediately increasing taxes. They use the money for all sorts of things. This includes building roads, bridges, and other critical infrastructure that keeps the country running smoothly, schools, and hospitals. These projects improve the quality of life for citizens and support economic growth. Think of it like this. The government needs a new library. Libraries are important community resources that provide access to information and education. They don't have all the money right now, so they issue bonds. People buy the bonds. This way, the government can gather the necessary funds without delay. This gives the government the money to build the library. The construction can start immediately, benefiting the community sooner. When you buy a bond, you're not just giving the government a handout, you're making an investment. Bonds are a way for citizens to contribute to national development while earning a return. You're lending money and getting interest in return. This system benefits everyone. The interest earned can be a reliable source of income for investors. The government gets the money it needs. This enables them to undertake projects that might otherwise be impossible. You get a safe and reliable investment. It's a win-win situation. Bonds provide a secure way to grow your savings while supporting the nation's progress. Not all government bonds are created equal. They come in different shapes and sizes. In the US, there are three main types: T-bills, T-notes, and T-bonds. T-bills are short-term bonds. They mature in 1 year or less. T-notes are medium-term bonds. They mature in 2 to 10 years. T-bonds are long-term bonds. They mature in more than 10 years. Which type of bond is right for you? It depends on your investment goals. Are you saving for a short-term goal? Or are you looking for a long-term investment? Think about your time horizon. This is how long you plan to keep your money invested. If you need the money soon, short-term bonds are the way to go. If you can wait longer, long-term bonds might be a better choice. T-bills are like the sprinters of the bond world. They're quick and efficient. They mature in 4 weeks, 13 weeks, or 26 weeks. You don't get regular interest payments with T-bills. Instead, you buy them at a discount. You get the full face value when they mature. The difference between the purchase price and the face value is your profit. Think of it like buying a gift certificate for £90 that's worth £100 in a few months. You're essentially earning £10 in interest. Not bad for a short-term investment. T-bills are a good option for parking your money safely for a short period. Maybe you're saving for a down payment on a house. Or maybe you're just waiting for a better investment opportunity. Section 5. T-notes, medium-term investments. T-notes are the middle child of the bond family. They offer a balance of risk and reward. They mature in 2, 3, 5, 7, or 10 years. Unlike T-bills, T-notes pay interest every 6 months. This makes them a good option for investors who want a regular income stream. Think of it like receiving a paycheck from the government every 6 months. You can use this money to cover your expenses, or you can reinvest it to grow your wealth even faster. T-notes are a good option for investors who are saving for a medium-term goal. This could be anything from a child's education to a retirement fund. Section 6. T-bonds, long-term investments. T-bonds are the marathon runners of the bond world. They go the distance. They mature in 30 years. Like T-notes, T-bonds pay interest every 6 months. This makes them a good option for investors who are looking for a long-term income stream. Think of T-bonds as a way to build wealth slowly and steadily. They're not going to make you rich overnight, but they can provide a reliable stream of income for many years to come. T-bonds are a good option for investors who are saving for retirement. They can also be a good way to diversify a portfolio that is heavily weighted towards stocks. Section 7. How to invest in government bonds. Investing in government bonds is a secure and reliable way to grow your wealth over time. These bonds are backed by the full faith and credit of the government, making them one of the safest investment options available. Investing in government bonds is easier than you might think. With the advent of technology, the process has become more accessible to everyday investors. You can buy them directly from the U.S. Treasury Department. The Treasury Direct website offers a user-friendly platform where you can purchase various types of government securities, including savings bonds and Treasury bills. You can also buy them through a broker. Brokers can provide valuable advice and help you navigate the complexities of the bond market. Another option is to invest in bond mutual funds or ETFs. These funds are managed by professionals who make investment decisions on your behalf. These funds pool money from many investors. This pooling allows for greater diversification and can reduce the risk associated with individual bond investments. They use this money to buy a variety of bonds, including government bonds. This diversification can help stabilize your investment returns over time. Finally, you can also participate in bond auctions. These auctions are held regularly and allow you to bid on newly issued government bonds. This is where the Treasury Department sells bonds directly to investors. Participating in these auctions can sometimes result in purchasing bonds at a lower price than the market rate. Each method has its own pros and cons. It's important to consider your investment goals and risk tolerance when choosing the best method for you. Direct purchase gives you the most control. You can decide exactly which bonds to buy and when to sell them. Brokers offer convenience and advice. They can help you make informed decisions and manage your investments more effectively. Mutual funds and ETFs provide diversification. By investing in a variety of bonds, these funds can help spread out risk and potentially increase returns. Bond auctions can offer competitive prices. If you're savvy and do your research, you might be able to get bonds at a discount. No matter which method you choose, investing in government bonds is a relatively straightforward process. With the right approach, you can make these secure investments a valuable part of your financial strategy. With a little bit of research, you can easily add these valuable assets to your investment portfolio. Government bonds can provide stability and steady returns, making them an excellent choice for both novice and experienced investors. Section 8. Benefits and considerations. Government bonds offer several benefits for investors. They are a popular choice for those looking to balance their investment portfolios with a mix of safety and returns. First, they are considered very safe. This safety is due to the backing of the US government, which has a long history of financial stability and reliability. This is because they are backed by the full faith and credit of the US government. Investors can rest assured that their principal and interest payments are secure. Second, they offer a predictable stream of income. This regular income can be particularly beneficial for those who rely on steady cash flow, such as retirees. This can be helpful for investors who are retired or who are saving for a specific goal. Knowing exactly how much income to expect can aid in financial planning and budgeting. Third, they can help to diversify your portfolio. Diversification is a key strategy in reducing risk and enhancing returns over the long term. This is because bonds tend to move in the opposite direction of stocks. When the stock market is volatile, bonds can provide a stabilizing effect. When stocks are down, bonds may be up. This inverse relationship can help to balance the overall performance of your investment portfolio. However, there are also some considerations to keep in mind. It's important to weigh these factors carefully before investing in government bonds. First, the interest rates on government bonds are relatively low. This means that while they are safe, the returns may not be as high as other investment options. This is because they are considered very safe investments. The trade-off for this safety is typically lower yields compared to riskier assets. Second, the value of your bonds can fluctuate. Market conditions, interest rates, and economic factors can all impact bond prices. This is especially true for longer-term bonds. The longer the maturity, the more sensitive the bond is to changes in interest rates. If interest rates rise, the value of your bonds may fall. This inverse relationship between interest rates and bond prices is a crucial consideration for bond investors. Overall, government bonds can be a valuable addition to any diversified portfolio. They offer a balance of safety, income, and potential for capital appreciation. They offer a unique combination of safety, income, and diversification. This makes them an attractive option for many investors. Just be sure to do your research and understand the risks involved. By being informed, you can make the best decisions for your financial future. Section 9. Conclusion: Government bonds and the conservative investor. Government bonds are a great option for conservative investors. If you're just starting out, government bonds are a safe place to put your money. They're also good for long-term goals like retirement. They won't make you rich quick, but they offer stability and peace of mind. And that's worth a lot. So consider adding government bonds to your portfolio. You'll be glad you did.